Hi everyone, this is Jason Burack of Wall Street for Main Street and independent financial journalist Eric Dubin. Welcome back to another Welcome to Dystopia podcast. This is episode number 41. So Eric, there's been some interesting things going on in the gold and silver market. There's been especially stuff about the commitment of traders in the silver market. We kind of haven't seen things like this in quite a while. So why don't you talk about the analysis that's been going on with the commitment of traders? So in the last couple weeks, there was record amounts of net shorts by the specs, which are the hedge funds for people who are not familiar with this. And what's your opinion on what they're starting to do now?
Typically, when we've seen a so-called wash, rinse, repeat cycle that is associated with COMEX and the manipulation of silver, the large specs, the hedge funds, they tend to be the suckers, the bag holders, when the institutional players, the gold cartel, commonly referred to by the Bill Murphy camp that got them, J.P. Morgan, etc., they're the ones who, as commercials, tend to manipulate the markets down. And what has been interesting is that the hedge funds have been going net short and getting shorter and shorter, these large speculators, and reached a level that is historically low. So they have to cover at some point, and that's representing kindling for an upward move. This last week, we saw something pretty interesting. Last Wednesday, and this is, we're recording this on Sunday, April 22nd. So last Wednesday, we saw silver take a pretty big leap way over to getting above 17, and it's been bouncing around between, 1650 and a pretty tight range, and finally got over. And that leap on Wednesday was kind of an outlier move that's interesting because for the very first time in a very long time, these hedge fund players, these large specs, were covering some of their shorts and going long. And usually the bullion banks, the primary forces that are associated with manipulating the market down, are the ones that get the market moves right. So it tends to suggest that some of the more speculative monies are getting interested in silver, and they decided to move their contract positions. So the last Tuesday COT report cutoff, COT numbers are reported each week with a calendar date or a weekly date cutoff on Tuesdays, and the commercials, the bullion banks, reduced their longs by 740 contracts and increased their shorts by 5,337 contracts, whereas these hedge fund positions increased their longs by about 1,500 contracts, give or take, and they cut their shorts. They're actually acting like the smart money as opposed to the J.P. Morgans of the world that are the commercials that manipulate the market down. It could be that we are seeing a speculative interest sweep into the hedge fund community. They're looking around. They are aware that there are more inflation pressures coming through the system. We'll speak a little bit about that later in the show. And silver has been in such a tight trading range and basically controlled ever since its move in January. I mean, it fell back down, and then, if you cut a central tending line between where it's been for the last 3 months, with the exception of this last week's spike up, it's been about 1650, give or take, 20 cents either side of that. So it's interesting that silver is peaking above 17 now, and it's catching interest of the speculators. Speculators make dogpile. They tend to be momentum-type traders, so it suggests that there are new interests looking at the silver market, and that's refreshing to see.
And it was interesting how large the short position had gotten for the specs, that net short position. I did a short video on this a couple weeks ago that from a contrarian standpoint, that was very bullish news because normally, like you said, the speculators are wrong. So occasionally they are right, but normally the commercials or bullion banks are right on the moves in the gold and silver market. And considering my research on the supply side for silver and how bad of margins the primary silver miners have, and how I've discussed this at length, for a while now, how many of the primary silver miners are trying to get a large percentage of their revenues out of silver. It was just curious that so many hedge funds were short silver. But, the silver market, I think, from a supply side standpoint, the primary silver miners, they can't really cut any more costs. And from speaking with Nolan Watson, the costs were actually starting to rise again for primary gold and primary silver miners. So they had cut all the costs to the bone to the point over the last, 7 years of this paper bear market where there was no more cost to cut without actually shutting down mines. And so to maintain current levels of supply, to replace mined reserves, to keep production levels similar to where they are now, let alone raising them, they were looking at, spending more money on CapEx, and they had delayed these expenditures for quite a while. So the supply side, whereas the hedge funds were saying, like you said, in the momentum, the hedge funds were betting the silver was going lower. I was looking at the supply side and saying, that's not going to happen. I mean, there's going to be huge problems with the primary silver miners if that had happened. So maybe, for a short period of time, that would have happened. Anything can happen in the short term, but for the long-term market, that was just not possible. The other thing is, Eric, we were discussing this, and I worded this incorrectly before we started recording. I've changed my wording on this, is that listeners don't want to hear this now because, the commitment of traders, it's not bullish in the immediate term necessarily. The news that we're seeing, it's not immediately bullish that, King World News, hyperbole that silver is going to go to 50 in a couple months or anything like that. But that long term, that is good. That the commercials do not have this massive net short position compared to what they had in the past. And the other thing is that people don't want to hear this either, is that compared to 15 years ago, silver is making higher lows now. So 15 years ago, silver could not really stay above $10. So if you've been in this market for a very long time, silver, now you obviously have to look way back at this, but silver is starting to make higher lows. And a lot of that has to do with the supply side, with the inability of the industry to replace economic reserves at higher grade. So these are outlining the supply problems. Otherwise, if the people were right, and we get, Eric, whenever I put, and you read the comments, whenever I put positive videos out about gold or silver, interview a gold or silver expert, for really 6 months now, the comments are just nasty. Just absolutely nasty. I mean, the comments about Bitcoin are also nasty now too. So basically, if I have anything nice to say about Bitcoin or cryptocurrency now, or I interview an expert or I interview a gold and silver expert, and they have anything nice to say about gold and silver, I just get these nasty, page-long comments about why am I even covering it? Why am I even covering precious metals anymore? And so, people don't want to hear even a sliver of good news. They want to see the price move. But, if the manipulators, Eric, were so successful, and yes, they've capped the price, but if the manipulators had complete and total control of the market, why is the silver price then, not capped at $10 an ounce and lower? So I think a lot of the people who are, writing these comments, a lot of them bought silver at much higher prices. They don't want to, I think they're being too emotional right now about a lot of their investment decisions. And there is some good news starting. And that's that basically, the manipulators, Eric, and you can chime in now, I don't think the manipulators can get silver back below $15 an ounce for very long. Maybe in the short term they could if we do have a huge stock market crash like some of these major investors. We'll talk about this a little bit later in the program, like Mark Mobius and Jeremy Grantham are predicting, maybe there's a big sell-off in everything temporarily, but silver's not going to stay below $15 an ounce because really no primary silver miner can produce economically at that price. So I think, it's taken years to do this, and the manipulation has temporarily capped things at artificially low prices, but we've been building a pretty strong base, at this level for silver for a while now, and in the near future, maybe 12 months or less, we could potentially go quite a bit higher.
Yeah, I mean, we bottomed out in silver at $13.62 back in the latter part of 2015. And 2016, we saw a pretty big spurt in silver and miners, and there was a lot of interest coming back into the market, and then it just kind of faded back down, but we never hit those lows in the 2015 period. We never went below 1434, and that came mid last year in July when the markets bottomed out. We had a lot of freaky action actually back in the summer, like flash crashes, as many of our listeners would recall, just the market being bombed basically. And ever since then, that actually makes your argument in a roundabout way, because back in July, they were in fact bombing the stuffing out of the precious metals space, and indeed, because of the cost of production being such as it is, and the demand underpinning for physical, we never saw silver got below 1434, even though back in the year before it was, or a year and a half before, it was in the 13 handle. So that's your argument. And ever since, we've been kind of trading somewhat sideways with higher lows. We, in 2018, have finally gotten out of the 15 handles that we plumbed towards the end of the year, when frequently the precious metals markets are bombed. And we've been going sideways ever since that big jump that we saw in January, and now we're coming out of a compression that I just described earlier in the show, where $16.40, 50 cents has been kind of like the central tendency for 3 months, and then all of a sudden last week we jumped up higher. So we've had a long consolidation. This isn't precisely the time that people should be establishing longer-term positions, and because of the kind of despondency that we have seen in the market, that's what you're looking for when you want to be a long-term value investor. And the COT numbers are interesting as well from last week, because even some of the hedge fund speculators apparently agree with that thesis and are no longer going as short as they were before. So they're not, and they were in fact not the bag holders for the bullion banks last week.
And David Morgan says, and he's researched, trading for decades. He says you're not supposed to sell quiet markets. So the silver market is pretty quiet for right now. Gold is obviously had bigger moves than silver has, so there's a lot more interest in the gold market right now than silver, and I think that's why the gold to silver, one of the reasons why the gold to silver ratio is where it is. But, silver is a quiet market, and I wouldn't sell it right now. If you're a contrarian, if you have money coming in, I think it's a good time to add. But the other thing is, in a couple of years from now, Eric, there's not going to be economic silver available at $15 an ounce. They are pulling out so much silver out of the ground each year that in a couple of years from now, considering that the mining companies have delayed the spending for costs to replace reserves and buying new mines and things like that, there's not going to be a lot of economic silver left at 15. So the people who are extremely bearish silver and saying, the manipulators are going to cap this for forever, they're not going to allow the prices to rise. Well, why didn't the manipulation of silver down to 10? There is very little silver left to be mined at $10 an ounce or lower. There's one new mine, I think, that's going to come online, Eric, in the next 2 years or so in Mexico. It's Mag Silver, MAG. I've talked about it, and I think that's the only new mine I've seen out of the dozens and dozens of potential new silver mines that has costs around $10 an ounce all in. Every other potential new silver mine, Eric, needs like $25, $30 an ounce silver minimum. So the people there who are saying that, the manipulators are going to cap this price forever, they're going to knock it down even lower, well, then the demand for the physical metal is going to have to be totally reduced. They're going to
It's a specious argument, and bottom line, okay? In the latter part of 2015, we bottomed out in the market, 1362 in the fourth quarter of 2015, and back in that period, the major, certainly the pure play silver players, we had cut their costs to the bone, and the majority of them were not economic producing. So, that's what marks bottoms in commodity markets, when the cost of production gets to the point where it establishes a floor in a market, and then when you add on the psychology and trends that one can see with speculators and people posting comments on videos like what they post at Wall Street for Main Street, that's just, the despondency is actually a good thing.
Yeah, and there's the old Sir John Templeton quote that bull markets are built on pessimism, rise on skepticism. And so it's a longer quote than that, but for the market to really bottom, there has to be a lot of negativity, the blood in the streets type of comment. But if I had to summarize the silver market now, Eric, I would say silver is not rising a lot yet. But I think, based on the supply problems that we see, the industrial demand for silver is still pretty strong, although Louis Camersano said that it's decreased slightly in certain aspects. We still have strong silver demand out of China and India, though, that silver can't crash more. So silver is not rising a lot yet, but it's also at the point now thanks to some of the things we laid out in the last 10 minutes or so discussing the silver market, that it also really can't crash too much anymore, unless, it's just sold off like everything in 2008, how silver went from 21 down 8, and how everything, the baby with the bathwater, everything sold out.
Yeah. And basically we have a compression in the market, since 2017. We had highs from 1866 going down, 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 down. And then meanwhile, from last July, when they did do that flash crash, freakish bombing, and ever since we've seen higher lows. So when you get a kind of triangular wedge thing like that, and horizontal trading for a period of 3 months, give or take, the resolution is more likely than not to the upside. And that's what we're going to see, because that's going to correspond as well to rising inflation expectations, the interest rate paradigm shifting upwards, trade war fears also compounding inflation expectations. And so, the precious metals have been in a very long consolidation. It's ripe to move higher. And when the equity markets go down, we will see a lot more interest in the precious metals complex.
Agreed. And there's also a lot of increasing volatility across the board. Although the VIX recently has been trending back downward, that's probably due to the leverage short volatility trade. But we are seeing an increase in volatility across the board. And I think the smart money, so this is not retail, because we get a lot of comments underneath my videos, like I said, from a lot of retail listeners in Europe, Canada, and the United States about how they don't want to hear anything good about gold and silver. They don't want to hear anything good about Bitcoin and cryptocurrencies. But the smarter money, the hedge funds, the institutional players who have made a lot of money in stocks and bonds and real estate for years now, Eric, since this central bank reflation of tens and trillions of dollars in liquidity injections, they have been taking money off the table. So this leads us into the next topic. I wanted to spend a good amount of this particular Welcome to Dystopia episode talking about following the money. What are the smart money, the institutions, the hedge fund managers, the big name investors doing? Are they giving us warning signs about what they're doing with their money? And, based on the current events that have been coming out lately, whether it's Mark Mobius in the last couple of days, a very well-respected contrarian value investor over the years. He just retired recently at age 81. He has a very successful track record. I think he worked with Sir John Templeton, who's one of my favorite all-time investors. He's warning about a 30% U.S. stock market crash in the near future. We have Jeremy Grantham, who's a very well-respected value investor. After about 6 months ago, I believe he was predicting a stock market melt-up higher, which he was mostly right about. He's now saying that in the near future there could be like a 20 to 40% stock market correction in the next year, 12 to 24 months. So we are starting to get the warning signs. The other thing is, and this is anecdotal evidence, but a lot of the people I listen to, Eric, advise hedge funds, they advise institutional investors. So these hedge fund analysts, these professional investment consultants, and a lot of these guys do interviews on the Macro Voices podcast that Eric Townsend hosts. So you can go and listen there. They're starting to tell their very high net worth clients to start fading or selling the rallies in stocks. So we're having this, we've had it now really since, it started a little bit before February, but really February, the spike with the VIX, the LIBOR spreads, the LIBOR OIS spreads increasing. These are all signals that we're starting to have big chop. So we're starting to have routine, 2% up, 2% down days. These are normally those types of moves, not moves that we have when, the bull market's continuing and everyone thinks there's easy money to be made at the top. I think based on the research that I've heard from these analysts talking about it, it looks to me, Eric, like a lot of the buyers in stocks, so there's still buyers in stocks, but it's not the hedge funds and the institutions who are buying necessarily. It's more the retail with the mutual funds and also the passive investing, the ETFs, that are doing the buying on the buy side. And those are considered more of the dumb money that are going long stocks at this stage. And a lot of the big money, smart money people who have already made money, a lot of money in stocks, those are the ones who are starting to liquidate or distribute some of their positions.
Yeah, we are seeing that. And in particular, when you look at market cycles, it usually is the retail investor that comes in at the very last part of a bull move. And we've seen things like record low levels of margin debt in stock brokerage accounts that indicate that the retail investor is more aggressive now than, and all the way through to like the fourth quarter of last year, than they have been in years. We see that, you know, they're the ones who are getting excited after having looked in the rearview mirror with a stock market that has largely been going up and up and up. And meanwhile, the markets had a pretty decent-sized correction in January that was riding on the back of a pretty significant move in the, you know, interest rate paradigm, as the Federal Reserve has been threatening to normalize their balance sheet, and as we've had these inflation pressures come into the marketplace, and even the Treasury Secretary back on January 26th had mentioned in Davos that it was a good idea for the United States to see a lower dollar, and people were freaking out about that. That actually was the day that we began, or the following day, if memory serves, that correction starting in the S&P 500 when it came in January. We went from, I'm looking at my chart here, 2.32% on the 10-year yield in like the last week of November, and rocketed all the way to test almost 3%. That's a really big move in just a couple of months, and that ultimately upended the equity market. It was behind part of what pushed the stock market to correct back in January, and now we're just kind of floundering around, and ironically enough, the 10 years is right about now to take another stab at that 3% level, and I fully expect it to, in May, exceed 3%. The confidence in the U.S. dollar with trade war talk going on is also going to be under pressure. That will contribute to people thinking, you know, that the bond market is just going to unravel. It has been an artificial creation for years now. We have had the biggest bond market bubble in 400 years, and as the central bankers have tried to unwind what they began, and particular since 2012, but going all the way back to 2009, ever since the crash, we've seen just a distortion in interest rates that is the biggest distortion in markets in world history. The price of money, interest rates, prices everything else, and the markets have been massively distorted ever since.
Well, that was the only way, Eric, for them to manipulate interest rates lower, was to buy the private sector time. The governments did this, the central banks did this, to make it look like a real recovery. It wasn't a real recovery. It was obviously a fake recovery, but, they're selling people that it was a real recovery. And, a lot of people I talk to now don't even remember what happened during the 2008 financial crisis. If you listen to Mark Faber, and I agree with him, there's lots of people on Wall Street who've worked there, and they weren't even around during the 2008 financial crisis.
Yeah.
So,
most traders are like, 50, I don't remember what the numbers are, but well over half have barely been in the markets long enough to go back before the last crash.
Oh, yeah. Yeah. I mean, they hire them right out of Harvard, the Ivy League schools, either undergrad or Harvard Business or Wharton, the University of Pennsylvania School of Business, for the MBA. So, it's just really crazy at this point that look at the tens of trillions in liquidity they had to do, look at the artificial manipulation of interest rates, and we didn't even get a real recovery. We got enormous asset price inflation, and it didn't help Main Street, and it actually widened the wealth gap. And, this is, I don't know if the central banks and the governments did this intentionally. I think some of the people...
They did.
Well, bleeding heart Janet Yellen might have hoped that some of the money would have trickled down to some of the people on Main Street. But, yeah, I think a lot of the people didn't really care who were involved in this. But, I mean, look, it bought 10 years since the last financial crisis, but look how much liquidity had to be created. I think it's at least $60 trillion that the central bank, if you add up all the injections from the People's Bank of China, the Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England, if you add all those up, I mean, it's at least $60 trillion that was created out of thin air just to get us to where we are now. And it's really, in a lot of aspects, I think it's worse than 2008 because there's, so many more problems that are larger that have not even been solved. But I wanted to spend a good amount of this episode, Eric, talking about following the money. What's the big money doing? So, retail, we discussed this, that retail and the ETFs, the passive investing ETFs, are still buying stocks. Those are most of the buyers at this point. Maybe there's some very short-term, high-frequency trading hedge funds that are still long, but the more fundamental-oriented hedge funds and institutional investors that focus on fundamentals and valuations, those are the ones, Eric, who are selling or fading the rallies. And so more evidence of this is what Berkshire Hathaway is doing. So while Warren Buffett might say one thing in public and say the stock market's not overvalued based on interest rates, well, what's he actually doing with his firm's capital? And so Berkshire Hathaway now, Eric, has a record hoard of cash position. They have $110 billion with a B billion, $110 billion waiting for a stock market crash to go and buy things on sale. So he may say in public that stocks are not overvalued historically based on interest rates, not talking about, the unprecedented intervention by central banks, the manipulation of interest rates, right? But look at what he's doing, not what he's saying, and the man has enormous amounts of cash on the sidelines waiting for a stock market crash, plus those comments from the other big name investors too, and all those other consultants that if you listen to the Macro Voices podcast, who either manage billions of dollars in money or advise people who manage many billions of dollars in money, are now telling their clients for a couple months now to start distributing stock and selling it on each rally. Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/WS4MS. That's healthiq.com/WS4MS. So, Eric, why do you think, one more comment on Buffett. So why do you think Warren Buffett, who's made his fortune, before he became, obviously this crazy politically connected, corrupt crony, he is actually, in my opinion, one of the greatest investors of all time. He didn't do it with politics. He actually, early on in his career, if you speak with people who have studied Buffett, he didn't talk about politics at all. He was just, a stock picker. He compounded, I think, 30% average annual returns. Just amazing. And so why do you think a guy who, made his whole career, made those types of returns, became a billionaire with market inefficiencies, why do you think he made a bet with a hedge fund manager betting that a index fund, a S&P index fund, would outperform hedge funds? Do you think then he was betting that the central banks would continue to, do you think the main reason that he made that bet was he's betting that the central banks would intervene and continue to prop up the stock markets?
Well, you're going to have to school me on this because I'm not familiar with this particular piece of news. So apparently he has gone long on an index for the S&P 500 versus stock picking.
He actually did the bet a couple years ago, and he bet a hedge fund manager about $1 million as a gentleman's bet for Buffett that the S&P 500 index would outperform the 5 best hedge funds that this hedge fund manager could pick. So obviously, the hedge funds charge very high in fees, but if they were skilled stock pickers, you would think that they would still have a shot to outperform the S&P 500, the index, and the index absolutely trounced the 5 hedge funds that the hedge fund manager picked out in the bet. But in the past, though, Warren Buffett would not have been in favor of indexing, right? Because he's in favor of market inefficiencies and picking out individual companies, not indexing.
Yeah, well, but I'm not entirely sure that he was, he might have actually been making a point against those specific hedge fund managers as a generic statement about hedge fund managers being bozos. Buffett, if he was, challenging them to say a gentleman's bet against the stock of Berkshire Hathaway, might have been a different story. I mean, I wouldn't go to infer that Buffett is making an argument in favor of indexing, because he's not. He's a stock picker. What is interesting about him is that he might be, looking around and thinking, just like all these other professional investors, at the reality of the long duration of our economic cycle since 2009 and chugging along as being the longest. Never mind the fact that the economy has not recovered and the job situation has been hollowed out, et cetera, et cetera. It's the longest up cycle that we've had, and the markets have been absolutely bonkers and driven by this kind of liquidity spigot that in 2017, where we had 300 billion plus worth of net liquidity additions from the Western central bankers plus Japan coming to the market every friggin' month. And when you look at a chart of the S&P 500 over the last 5 years, you can see periods where we just had 45-degree angle move. 2015, and through half of 16, we had some consolidation, some volatility, and lo and behold, 2017, we started taking off and blew off into a blow-off top last January. At the time, within a week of that blow-off top, I went on record saying that was the top of the markets. We have seen the top of the markets, in my opinion. We are going to continue to drift mostly sideways for a month or two or what have you. It's hard to say exactly, but the interest rates rising over the course of this year is going to happen, and that's going to pressurize the equity markets. So, buckle up. we have seen the top in the stock market, in my opinion.
I definitely think volatility is back in here to stay. We'll have to see what the other central banks do, because the U.S. capital markets, the U.S. stock market, U.S. bond market, and U.S. real estate markets have really benefited from these other countries like China, the European Central Bank, and Japan doing all these liquidity injections. A lot of that money has leaked from those other countries into the United States. So even though the Fed hasn't done nearly as much QE, the U.S. asset markets have benefited from all those other countries doing. A lot of that money has come here. But something to add, I think our listeners out there, if they haven't done so already, Chris Martenson released an interview last week with the Doug Duncan, that's the guy's name. He's the chief economist at Fannie Mae. So Fannie Mae's, for those of you who are not familiar, they're basically a government-sponsored enterprise. They're not a full government company. It's a quasi. But obviously during the 2008 financial crisis, they got a full bailout. And the government is guaranteeing, the mortgages. So after the banks make the mortgages, then what, Fannie Mae and Freddie Mac buy them up, right? And so he's basically a U.S. government economist, more or less. And he actually went on the record with Chris Martenson, and he actually said, and I was shocked to hear this, that he expects a really bad recession by the end of 2019. So he was talking about how U.S. housing, and, Fannie Mae makes their billions of dollars a year off the U.S. housing market. And he was basically saying how drastically overvalued the U.S. housing market is at this point, how maybe in the short term it could get a little bit more overvalued, but it was getting ridiculous. And also, talking about how he expects, with the combination of these factors, Eric, that you talked about earlier in this interview, with trade wars increasing, with potential interest rate hikes, with potentially central banks, the 5 or 6 major ones, potentially maybe temporarily reducing their balance sheet or their QE liquidity programs. And he expects this by the end of 2019 to really cause a lot of problems, maybe a stock market crash. He said a official government recession. So, and we know, you guys know who listen to my channel, that the government statistics are bogus. So for the government statistics to say that there's a huge recession, things are a lot worse in real life than the government numbers are saying. So for the government numbers to say, according to Doug Duncan, by the end of 2019 that we would have a really bad recession, things on Main Street in the real economy would be even worse by then.
Yeah, and one of the things that's interesting about the interview he had is he is talking about how we have reached basically peak debt, and that it's a concern of his. And one of the things that he had mentioned in the interview, and I'll quote, "So what keeps me up at night? Well, I don't like the idea that we have a debt-to-GDP ratio of 100%. I don't think we're Japan because we have more entrepreneurial economy, but not a mercantilist economy, but that doesn't mean that debt doesn't reduce your flexibility." And he's honestly concerned about how we've had a decline in new business formation and the vibrancy of the economy is lower, and that he even speaks of the creation of a permanent underclass in the United States as people get more and more poor, and the level of income growth stagnates. And when an economist at Fannie says stuff like this, and they're riding on top of the entire mortgage industry, it's time to take notice. It's interesting that somebody would be that frank as a government-employed economist.
Yeah, and we had similar comments from the head of the People's Bank of China about 6 months ago. I think it was November, actually, 2017, and the guy talked about Minsky moments in China.
Yeah.
And so for the head of the People's Bank of China to be that candid and worried about debt problems and credit growth in China, I was shocked to hear that, considering how normally, basically with economic propaganda and spin, the Chinese government normally is lately. I just hope the guy doesn't suffer a really bad fate, get sent to a work camp like what Chairman Mao had, or some type of, maybe they pin some type of corruption charge on the poor guy, and he gets... Dude, I mean, in the past, the Chinese government has done that type of stuff. So
yeah.
hopefully the guy does not suffer a fate like that. I think it was honest, and I appreciated it. But, normally with a government like that, you can't speak your mind, especially if you're in a high bureaucratic position like that. You can't speak your mind candidly about stuff like that. So it is refreshing, like you said, to hear Doug Duncan, who basically is a very high-level government economist, come out and say that. So I think, I think the whole thing is with this timing of when we're going to have official government numbers recession, the timing of a stock market crash. I don't want to time this thing exactly, but we are seeing, and this is the important point, like I said, the smart money who has made a lot of money for years now in the rally in stocks, bonds, and real estate since 2008, the reflation from the central banks, they're even worried now.
Yeah.
And so we are getting warning signs that in the next 2 years or so, it could happen anytime in the next 2 years. But I would be shocked if this goes, longer than 2 or 3 years before there is problems. And I'm not saying the problems, Eric, are going to start in the U.S. I mean, they could start in Japan. They could start in Europe. They could start in China. But somewhere the problems are going to start. You just cannot keep putting, trillions and trillions of liquidity in, and everything's going to be hunky-dory.
We're staring straight in the face of stagflation, and that is going to lead to a recessionary dynamic in the United States within the next 12 months. It's happening right now. The yield curve is flattening and beginning to, it'll eventually invert, and that's a classic signal as well. And, we've had the longest economic upturn cycle, quote unquote, in 50 some odd years. And
yes.
It's not real. It's been liquidity driven. We were talking about how some central bankers have been honest about those kind of things. The former Federal Reserve president of the Dallas Fed, Richard Fisher, flat out said a couple of years back that we borrowed from the future to create economic demand and mortgage the future and created an asset bubble. And that's exactly what we've done. Sometimes they do tell the truth.
Agreed. Sometimes they do tell the truth. And Danielle DiMartino Booth, in her book Fed Up, she actually said that Richard Fisher said this before he left the Federal Reserve, that they would print so much money that there would be people on the streets with pitchforks by the end of this. So after the next bubble burst, after the next financial crisis that was going to be worse than 2008, that's what he expected at some point.
Fisher was definitely colorful with his comments in the media, so who knows, maybe he'll end up in one of those China camps with fellow government employees,
Well, he wasn't a PhD economist, so he wasn't, this bureaucrat, this Keynesian bureaucrat. He actually had real life experience. He worked on Wall Street, so he actually had more common sense than the majority of monetary mandarins, PhD economists making decisions at these central banks.
Yeah.
And so, maybe Jerome J. Powell also the other thing I wanted to add about that Doug Duncan interview was because of his high position at Fannie Mae, he actually got an in-person meeting with Jerome J. Powell, the new Federal Reserve Chair, after Powell was elected Federal Reserve Chairman. And he said his thoughts when he was speaking with Powell was that Powell doesn't mind a larger crash in stocks, that he wants to, at least for a while, break away from this what's the right word here? This view that the markets have that the Federal Reserve will always have their backs, will always put a put underneath stock market prices that Greenspan and Bernanke and Yellen had, where, the market would throw a taper tantrum. Anytime it looked like the Fed was going to take the punch bowl away, the Federal Reserve would panic and reverse course. So it seems to me that Powell may care less about asset bubbles, or at least allow a correction before the next round of QE. That was his impression. That was Doug Duncan's impression of Powell, at least.
Yeah, and that, would correspond to the Federal Reserve trying to somehow, some way, pull back the punch bowl from an ongoing party, because indeed the central bankers around the world realized that they threw too big of a party and there's a lot of drunks around, and they have to do something with respect to these bloated balance sheets. So, half of what they do is expectations management with what they say in the markets. For example, how the Fed comes out and speaks about the dot plot and how they telegraph expectations about how many interest rate hikes will come in this year, next year, etc. As we see interest rates rise, it seems that Jerome Powell is probably going to tolerate a lot more volatility as well as corrective forces coming into the equity market. The central bankers do not want to have a crash, but they do see that the markets are way out of balance, and as they try to fix the balance sheet messes that they've created in all of the central banks, they recognize that the equity markets are going to get an earthquake. And what's interesting about Powell in particular as well is that we can look back in history and see his comments in 2012 in an FOMC meeting where he piped up, and the transcripts were only out, I guess, about 4 months ago or so. They release them every 5 years. And he noted grave concern about how the Federal Reserve was suppressing volatility and creating an artificial bubble in markets. And that was a behind-the-scenes comment in the FOMC in 2012, insulated from any kind of expectation that someone would be, checking up on what the Fed is saying. And it shows where his head was when it came to what the Federal Reserve policymakers were doing at the time, which was blowing up a gigantic asset bubble. So that's our current Fed chair right now. He actually has a brain. He knows what's going on. He's not like Yellen, who was more like an autopilot kind of political apparatchik at the Fed, kind of riding coattails of Bernanke. And it's going to be interesting to see what Jerome Powell does. I think he's going to not rush quite as quickly to catch down moves in the equity market, which could create a little bit more volatility, but to assume the Federal Reserve is not going to panic and try to catch major corrections is foolhardy. So, Jerome Powell may have a little bit of an independent streak, but same leopard, same spots, and the Fed is the Fed.
And the other thing is, all this is going to, or at least some of this is going to be out of Powell's control. It's going to be on President Trump and how the Chinese President Xi and his economic advisors and trade advisors decide to react. So, we've already, obviously all of these tariffs have not been enacted yet, but there's already been at least threats of $150 billion minimum in tariffs. And so, this could escalate even further, and the Fed wouldn't have a lot of control over this. Plus, you have President Trump and the U.S. Secretary of the Treasury, Steve Mnuchin, who want a weaker dollar. So all of these things, there are signs that even with the government numbers, whether it's the producer price index or how, at least with part-time jobs and that there's some wage growth there with some part-time jobs. So those things could start to move the stagflation argument further. So in the real economy, we've been discussing this for years on Wall Street for Main Street, that recently I just paid Eric for what a steak used to cost about 10 or 15 years ago, a steak dinner at a decent restaurant like an Outback Steakhouse. I just paid for a plate of smoked chicken wings and beer or a good hamburger. So what a pretty good steak at a pretty decent steakhouse about 10 years ago, 15 years ago, now for the same price, I don't get a steak anymore. So at a restaurant, I either get a pretty good hamburger or just a plate of grilled chicken wings and a beer. But there's no inflation, right? So, and the Fed has to increase its inflationary target to 2%. So when you add up the fact that a trade war, that could potentially drastically increase stagflation very, very quickly, because all of these companies that are producing goods that potentially have tariffs on them, Eric, not only is there wage and price controls that could be put into effect in the near future from some of these ridiculous things that we've seen in the past financial history, whether it's Smoot-Hawley and others, wage and price controls that eventually in a trade war. But, that's going to start with these tariffs, retaliatory tariffs. It's going to start putting higher and higher costs on different items in the supply chain. And so instead of, productivity increases, new technology reducing costs, that could start to offset the reduced costs from those things, and we could see, politicians and bureaucrats forcing costs on everything higher and higher.
Yeah, and the initial salvo that came from the Trump administration back on April 3rd was $50 billion in goods that was published by the U.S. Trade Representative as targeted for tariffs, and now they're talking $150 billion. So it's beginning to appear on the needle as something that's significant and can, in fact, have an impact on the economy and filter in through higher prices, boosting inflation.
And the governments are also picking winners and losers. So Trump is, marching out like a couple workers from a plant in Kentucky, whether it's aluminum or steel, right? But, and we've had listeners comment underneath some of my short trade war videos that I've done in the last month or two about this, that they're going to be collateral damage. We have a good amount of farmers who listen to this podcast, and they are really worried if China retaliates and, puts high tariffs on American agriculture products, whether it's pork or walnuts or soybeans or other things. So, Trump may be saying that, this trade war is going to benefit the U.S. government in the long run. It's going to benefit certain selected groups pretty well. Maybe their salaries will not drop, plants will not close, but there is going to be an enormous amount of collateral damage that maybe does not get accurately covered in the mainstream media because of these trade wars. And so maybe the U.S. economic statistics, Eric, will look good from these trade wars, and Trump can claim a win, and I'm using air quotes, a win in the trade wars, right? But there's going to be a lot of people hurt by this. And so that's the point I want to make, is it just because a politician is going to, and the history books are going to say that, so-and-so won a trade war, well, it doesn't mean that everyone's going to benefit equally from this win, in air quotes. Okay, well, couple more topics before we close up the show. So we'll talk about John Bolton at the end, because it's kind of comical that Trump picked him. He was talking about, taking the troops out, but with John Bolton as his main national security advisor, I don't think that's going to happen. But George Soros, he bought 10% of Overstock. There's other big hedge fund money moving into Overstock. Mark Cohodes is a well-respected hedge fund manager. He's been buying into Overstock. And recently, in the last couple weeks, it came out that George Soros, with one of his hedge funds, is going to start buying cryptocurrencies. So that didn't affect the cryptocurrency price right away, but really since that news came out, Bitcoin price has had basically a 40% rally. Ethereum has had over a 20% rally. So we do get a lot of comments, anytime I interview an expert now on Bitcoin or cryptocurrency or blockchain, saying all cryptocurrencies are going to die, Bitcoin is going to collapse, why are you saying anything nice about cryptocurrencies? But Eric, there is evidence that the smart money disagrees with the retail money about the future of Bitcoin and blockchain and cryptocurrencies, that all the money to be made is gone, that there's no more money to be made. So it's very interesting in that aspect. The other reason, so I don't think it was solely the Soros news that came out earlier in April why Bitcoin and the other cryptocurrencies have had a rally. The other major thing was tax loss selling is over. But a lot of people out there did not accurately account for their cryptocurrency gains. Did you see that news story, Eric, about this is truly a sad story. I think the guy made like 50 grand on his Bitcoin trading, and he got greedy and he sold his Bitcoin, and he tried to put the money into some of these altcoins. And so he didn't save any money to pay taxes to the tax man on his Bitcoin gains.
Ouch.
And then he put the capital gains into the altcoins, lost almost all his money in a couple months, and he still owes the IRS an enormous tax bill.
You don't want to have the IRS chasing, that's for sure.
Well, yeah. So I think they're garnishing his wages. So you gotta be really. They put it like a lien on his bank account, or garnishing is some horrific thing. So you got to be really careful about. There's free or cheap software programs that can keep track of your cryptocurrency taxes, trading profits, and capital gains taxes for tax purposes. There's at least a handful of them out now that are either free or under $100 to accurately keep track of all your trading. But now that we're past tax day, that should potentially also help put a bottom in the cryptocurrencies. But, we are getting really, in terms of blood on the streets, the sentiment levels for retail for Bitcoin and cryptocurrencies is extremely, extremely negative. But, like I said, the hedge funds, the institutions, the smart money, they're actually still looking at ways to get in on this. So very, very interesting. And the other thing about Overstock is, I'll add this really quick, Dave Kranzler covered this because, Eric, you're going to be releasing the second episode of WTF Just Happened this week as well, and maybe you'll talk about Dave with this, is that, Overstock in general, the stock, their e-commerce business or online retail is a shitty business. Okay, I think actually the revenues were bad at Christmas. They're not consistently profitable. So the people who are buying into Overstock, like George Soros, who owns 10% of Overstock now, and the other big smart money hedge fund managers, they're not buying Overstock because of the e-commerce business. They're buying Overstock because of Medici Ventures, which has a lot of profitable capital gains investments in blockchain-related companies, and because of T0, which I don't know if they officially did their initial coin offering yet. They were planning on a $500 million one, but I know there's I think there was some SEC lawsuits, and there's been some problems with Overstock not being able to raise enough regular capital selling their own shares. So it's an interesting story, but the bottom line is that the smart money is not buying Overstock for their e-commerce business. Okay, so our listeners, actually, if you want to argue about cryptocurrencies and why you think George Soros is getting into it and why he's planning on buying some of the major cryptocurrencies in their future, don't forget to comment in the comment section underneath the video. Last comment before we go, Eric, about John Bolton. So why do you think Trump picked John Bolton as his national security? That was, the Homer Simpson kind of dough moment where I kind of smacked my face. You've told me for years about how bad John Bolton is. There was actually Trump supporters on Twitter when Trump was thinking about picking John Bolton. There was actually Trump supporters saying that he was anti-deep state and he was anti-war, and so I took screenshots of John Bolton's name on the Council of Foreign Relations alumni list for decades. So I guess they either were trying to hide that or were not aware of that.
No, Bolton has been able to ingratiate himself within even libertarian circles in the Republican Party, and that's still a head-scratcher. The guy he's pretty noxious, and when it comes to his international relations history, in the 1980s, he was responsible for running death squads in Central America. He is now one of the preeminent neocon, foaming at the mouth, adherence to neocon perspective for foreign policy. And now that he's a national security advisor, you ask why he was picked? He was picked because the Trump administration has now been completely infested with neocons, and they wanted one of their brethren. Trump, the week before that this chemical attack happened, Trump was making noises about how he would like to see the United States pull out of Syria. And it just so happened that last year, before Trump flung, 53 Tomahawk missiles into Syria in a very similar kind of 1-2 step, where about a week, 10 days before, Trump had said that he would like to see the United States withdraw from Syria in the field, and the neocons that dominate the foreign policy establishment in his cabinet and control his policy. Trump doesn't control the foreign policy. And pushed him in a direction where, for political show, he launched an attack last year. This last so-called chlorine gas attack in Douma, in a suburb in Damascus, appears to be a false flag. And we had 3 attacks previously, and 2 of them were absolutely false flags, and one of them is questionable. This is a bad movie being replayed over and over. The targets selected, there were 3, were basically just bombing non-important targets, and it was a wag-the-dog display of political might to gain political favor in the United States. That's the bottom line. Robert Fisk, one of the preeminent international correspondents in the world, who's won more awards for his reporting in the Middle East than any other journalist alive. He works for the UK's Independent, and he went and interviewed some of the doctors in the field and the attending physicians that were working with some of the children that were being videoed by the so-called White Hat non-governmental organization that is a humanitarian organization, cough, completely supported by the West. They're completely ingratiated with the rebels that the West are supporting. They were the ones that propagated the information as well on these other false flag events. And Robert Fisk talked to attending physicians and 25 people in the area, eyewitnesses, and none of them could confirm that there was any chemical attack. And in fact, that in his assessment, some of the doctors had literally told him that the most famous child that was in one of these videos was in fact suffering from asphyxia. That they were hiding out underground because it's a war zone, and they had so much dust that they were being treated for dust in their lungs. The Organization for the Prohibition of Chemical Weapons finally was able to come in this weekend to do an assessment on the ground. And earlier this week, Western leaders were telling the Western media that Russia and Syria were obstructing this organization's investigative efforts. And in fact, it wasn't the case. It was, in fact, the United Nations United Nations Department of Safety and Security that isn't responsible for the OPCW, that in fact prevented the OPCW from going in and investigating. But the hyenas in the West, who are so out to fan the flames of war and jump on any kind of propaganda meme that paints Syria and Russia as evil, we're trying to basically say that Russia and the Assad government in Syria were obstructing the discovery of the evidence that Assad gassed his own people. This suburb was largely ridded by the Assad's forces of the rebels, and there's no rational reason why Assad would take an area that they've already conquered for the most part and go and gas it and compromise his own political position. The story stinks from 6 ways to Sunday. And it'll take another week to really get the full context of what's going on. But suffice it to say, this was just another example of the United States flexing its muscle for political show. And just as a final note, it's completely illegal in international law to launch the kind of strike that just was carried out. There was no investigation. The results of the current investigation are nowhere near complete. They literally got there yesterday. So, these kind of actions are all intent for political theater. And unfortunately, we're going to see a lot more of that.
And Eric, a week earlier, didn't President Trump say that he was going to start withdrawing the troops in the near future?
Yeah, that was my point. They did the exact same thing last year, and you spoke of Bolton and the whole neocon infestation within the Trump administration. So Trump is basically making those squeaky noises via his Twitter. And then the Boltons and neocons within his cabinet tried to shut him down.
Welcome, meet the new boss, the same as the old boss. So whether it's President Trump, Obama, George W. Bush, Bill Clinton, the neocons and the military-industrial complex pretty much, and the Council on Foreign Relations pretty much just runs the foreign policy, right? So it doesn't matter which candidate of which party is in charge, the foreign policy remains the same.
Indeed.
And I think John Bolton also recently, before President Trump picked him, I think he was also on record about talking about attacking Iran and Venezuela. So
yeah, he's always been fanning the flames of war, and Iran has always been or within the last 5 years, has been his top priority.
Oh, him and McCain, right? Because I think McCain had been talking about wanting to bomb Iran for a very, very long time.
He even did a joke that was really funny in one of his campaign back in the town hall, I think it was, and he made a stupid joke. You can go to YouTube if anyone's interested and just do John McCain, bomb, bomb, bomb Iran. He did this short spoof on the Beach Boys song. So, yeah, he's never met a war that he didn't like. He's quite a charmer.
Yeah, I'm glad McCain's not going to be in Congress anymore. I actually researched when I was in undergrad for one of my political science classes. I was writing a paper about corruption in Congress, and I started looking through some old books, and I found out that really in his first year in Congress, John McCain should have he committed felonies and should have went to prison, and that the more tenured congressman fell on a sword for him. McCain was actually directly involved in abscam and had taken a big payoff money and been caught in, that FBI undercover investigation. And so the more senior, tenured congressional people, they buried it. They took the blame for McCain a couple of the guys, and so they retired, they got their pensions and Cadillac healthcare plans, and then on top of that, they went and got big salaries lobbying when they left Congress. So they got maybe slaps on the wrist jail time, but as soon as they got out, they had, cushy jobs waiting for them if they did any prison time at all. And McCain avoided prison time entirely and just basically built a entire long career in Congress of corruption and warmongering. It's really sad.
He's quite the servant to the military-industrial complex. He always has been.
Well, I'm glad he's going to be gone soon. So I don't want to say too much bad stuff about the man, but I'm just glad he's going to be gone soon. So
what do you mean? We've nominated him as a perennial scumbag.
Yes. Well,
and he deserves it.
He does, but hopefully his replacement is not similar. Unfortunately, though, we've been getting a lot of recycling of pretty much the same type of foreign policy.
I actually know the person who primary challenged him in the last go around, and she's a pretty good politician, more of a libertarian.
Is that Kelly Ward?
Yep, Kelly Ward. Her politics is fantastic.
I thought Trump would endorse her. She's in the military, or she's the spouse of a military?
Yeah, I think her husband is a Marine, if memory serves, ex-Marine.
Okay, well, hopefully we get more competent politicians who are not as corrupt. But unfortunately, I think things are going to get worse before they get better. Especially here in D.C. It's the stuff in D.C. is just ridiculous that I see on a daily basis. I mean, it's bad. But anyways, though, we're over an hour, so that's it for today's show. That's episode 41 of Welcome to Dystopia, mostly about following the money and what the smart money is doing now, and how the stock market is in a topping process. So we're not saying an immediate stock market crash, but the stock market is in a topping process. Topping processes, Eric, can take a while to play out. And the one thing about a topping process is that there's volatility, there's chop, as the professionals say. So there will be a lot of up and down moves. There will be false hope, false breakouts. There will be probably fake rallies from plunge protection teams and central bank interventions trying to delay a massive crash. We've seen that with the European banks, and how, Deutsche Bank shares have miraculously had falling knife rallies. Falling knife rallies that, no professional trader would ever, if they were managing people's money, would ever buy a rally like that with a chart that had crashed. They would never go in there and buy. And, unfortunately, this is the type of new normal with manipulated or managed markets that we see. I hope this changes in the future, but I think things are going to get worse before they get better.
Until the cows come home.
Okay, great. Well, thanks for listening, and we'll look to put on another Welcome to Dystopia episode in the next month or so. And don't forget to check out Eric Dubin and Dave Kranzler's new show here in my channel that I'm hosting, which is called WTF Just Happened. Yeah,
it's going to be a good show. I've known Kranzler for the better part of about 15 years. He's got about 30 years of market experience, and very savvy when it comes to his understanding of politics and geopolitics as well, too. So we make a pretty good team. And between us, we've got just shy of 60 years of experience covering markets and politics. We'll take an angle that is heavily focused on precious metals, because that's primarily Kranzler's bailiwick as well as mine. But we're going to look at markets and politics and the confluence of how basically the whole system works, and give people a perspective that they're just not going to see on CNBC, etc. And you can check it out at Jason's channel, and follow Dave's work as well at investmentresearchdynamics.com. And if you're interested in finding out what I'm up to lately, you can always just find me on Facebook at facebook.com/Eric Dubin.
And you're aiming to have those episodes shorter than Welcome to Dystopia, right? Those episodes you're trying to get those, 30 minutes or less?
Yeah, we'll probably run 20 minutes, give or take.
Okay, cool. Well, you guys did a good job on the first episode. It was definitely interesting, although, some of these people now that are just so negative on gold and silver don't want to hear any analysis of it at all. I think there was a couple of those types. And there was some complaints about the audio, but I know you're working on that. So just stick with us, guys. We're gonna keep on improving here, and thanks for listening to this episode. Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone, despite YouTube censorship. And hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.